From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB. I'm Juliette Sarli this Wednesday afternoon. What a busy day. China's NPC kicking it off in Beijing. And then, of course, we've had US President Trump as well confirm sweeping reciprocal tariffs from April 2 and has been speaking in the past couple of hours or so. Let's have you caught up with where the market is finishing the day's trade. We are off by 0.7% on the CBO 200. When it comes to the ASX 200, a bit more of a weaker session, down about 70 points or 0.8%. 8,130 is where we sit heading into match off. So that's a new 20-day low. Worth noting amidst all the noise that's going on as well, there is a lot of companies trading ex-div. So one of the biggest draggers today was actually Treasury Wine Estates, which was trading without rights to its dividend. But let's get straight into the themes of the day. And of course, tit-for-tat very much sparking off in terms of China also announcing reciprocal tariffs, China kicking off NPC 2 in Beijing, as we mentioned. Those beautiful blue skies are back. But Donald Trump speaking to US Congress as well, really claiming that America is back. And US Commerce Secretary Howard Lutnick saying potentially that there could be some middle ground reached with Canada and Mexico. Trump, though, reiterating plans to impose those tariffs from April 2, but didn't mention specific countries, hasn't mentioned AUKUS as well, which is really worth noting. China stocks, though, very much rallying the government and unveiling this slew of new economic stimulus, this potential ambitious target of, again, 5% growth that they're looking for in 2025. And then when it comes to our economy as well, some green shoots coming through there. The economy growing faster than was expected in the December quarter, so 0.6% growth. That was actually the fastest growth in around 2 years. And a couple of reasons behind that. It does look like household spending, consumer spending did pick up. We had the tax cuts, of course, but also investors sort of positioning, or consumers, I should say, positioning for those expected anticipated rate cuts that did come, at least the first one in February. Let's have a look at what we saw in terms of sectoral moves today. Kicking it off with the miners as we continue to focus very closely on what is happening in China. You did see BHP and Rio both track higher, Fortescue down by about 0.9%, $15.97. Looking at the financial sector today, that was where we saw a lot of weakness on the overall bourse, drag down by Commonwealth Bank, which was off by about 1%, ANZ and NAB also weaker, and Westpac off by about 1.5%. And then the retail space, consumer discretionary, very much hit hard today. JB Hi-Fi down around 2%, Harvey Norman also weaker there, and Coles and Woolies, worth noting that the big drag you're seeing there was also in reflection of them trading ex-dividend. All right, Clarity Pharmaceuticals, meanwhile, bouncing back. It signed a new supply agreement with the University of Queensland. You know, when we've got stocks on the board like this, that it was a quiet news day. We heard from Air New Zealand flagging performance to be significantly lower in the second half, and Albion Resources jumping to a 3-month high on a CEO appointment. Let's get straight into the COB now with our guest, Mark Gardner from MPC Markets. Really hard to keep up with all the headlines coming up, but how are you sort of seeing the start of March, given February was such a painful month?
Probably not much different realistically, except we don't have earnings to distract us this time around. So obviously that GDP number today was obviously on the headline pretty positive, but we're now at record spending from governments. So the numbers really in an election year, you've got to take with a bit of a grain of salt overall. Many would be saying, best growth, why did the RBA cut? And I was one in the camp that thought that we shouldn't cut. But those numbers are being propped up by government spending. Someone's going to have to, obviously that's going to have to be unwound at some stage, usually at the start of a government cycle, definitely not towards the end. So yeah, I think overall we're sort of starting to see where the market was really overextended in the retailers and the banks is starting to just come back to a little bit of normality, and even still sitting at the high end of valuations. However, they're not overstretched at super high record valuations, and the miners, it doesn't really show green shoots necessarily. They're just not getting hit. So the mining sector, by far and away the worst sector last year. Them and energy were down 21 and 20% as sectors. So I don't expect to see too much more selling. It was good news out of China today. At the moment, we managed to keep our head down and stay out of the firing line with Trump. But look, it's rough to keep up when even just reading the Financial Review today, the stories that came out this morning versus the afternoon are two completely different things, and we're 4 hours, 6 hours apart. So it overall, Trump this morning doubled down and was saying he was going to retaliate against the retaliations, and now they're saying he may water it down a touch. So, but good news out of the NPC, targeting that 5% growth, and I think good news for Aussie farmers as well. Obviously, beef exports hit record highs. We're going to probably have our third biggest crop again on the eastern, just because the eastern seaboard conditions, and you've got the likes of RFF. Elders Grain Corp trading at super cheap prices at the moment. Weather conditions will extend out, and then China's looking at putting tariffs potentially on the US agriculture, which will definitely benefit the Australian farmer here as well. So those favourable conditions have been stretched out nearly another year, which is a far cry from when we were calling El Nino not that long ago, which was a shocker from the Bureau of Meteorology. So some of the defensive sectors, if people are starting to get worried about the market, are quite cheap. So and to be down 0.7 on a day where we've had some pretty heavy weakness,
it's not too bad.
There's a lot of dividends out today from a lot of big companies. I think that's not a bad result overall.
All right, now you talked about the eastern seaboard, so we do have to think about Cyclone Alfred bearing down, what this means potentially for the insurers. Yeah,
the insurers have had a great run, and they had basically their best catastrophe free, well, not catastrophe free, but their lowest cost of catastrophes, particularly in Australia, for the last, I think, 6 years. But look, the insurers are starting to look a little bit expensive anyway. These sorts of runs don't generally last for particularly very long. We tend to hold Johns Lyng Group as a pairs trade. So quite often you can hold the insurer and the repairer. So obviously one can recover, and then if one comes off, that reduces or smooths the risk in the trade overall. Johns Lyng Group at the moment, extraordinarily cheap. They weren't able to comment on catastrophe over earnings season, which is their policy, but they're set up in the US now. They've got offices all down the East Coast where the hurricanes were, and they've got offices all down in California, and they haven't even got the assessors in there. So that would be a way, if you didn't want to sell your insurers, you didn't want to take capital gains, you'd probably maybe buy some Johns Lyng as a bit of a hedge, I suppose, in a way, because they will do well if the insurers have got to pay out. So, but fingers crossed there's not too much damage overall. I would be looking generally to be selling the insurers at these high valuations anyway. They're not typically high growth companies. The Mother Nature has a way of derailing those long term, those long runs of no weather incidents.
All right, let's talk about energy, because OPEC Plus planning this output when you've already got a glut. We've got a lot of impact here to some of the energy players. I know Woodside's going ex-div tomorrow. Are you looking at any sort of buy on the dip or? No. Energy's really off the table until we work out what Trump's essentially doing. Him butting up a little bit to Russia also concerns us somewhat, because there's obviously supply locked up there. China's hasn't really kicked ahead as yet, and they're still talking about having to stimulate to get to that 5%. They're obviously the largest oil importer in the world. So at this point in time, Drill Baby Drill he wants energy prices down. So we've been investing in Worley. So essentially still in the energy sector, but more so in that infrastructure. And they're still doing their renewables. I think they're about 50-50 now. But if he wants more supply, they're going to need more infrastructure. And the higher margin stuff's on the renewables side. They just got a large contract with the Norwegian government, I believe, a 7-year contract, which was quite sizable. So that's how we're playing the energy sector at the moment, and just until we get a little bit of settling down, because a trade war is not going to help. It's not any sort of investor certainty, and things like oil prices tend to, if we're going to get a small economic slowdown and then it takes off from there, like Trump's talking about, like small interruption, I think oil prices will probably bear the brunt of it in the short term. But and then probably just be a little bit patient with those players, because they will be very cheap at some stage.
but I don't think now's the time. I think in the resources sector, you're starting to see jumps up in copper, iron ore. I mean, it's been up, it's been down, but it's really roughly around the average price it's been for quite some time. Bit of stimulus in China should obviously help that. And I think we'll probably see a bottom forming in the materials sector well before the energy, and maybe energy towards the back half of the year.
What about some of those other sort of China plays that really got hit in the last trade war, if you will? I know Treasury Wine Estate was ex-div today, but it fell a lot more than its dividend.
Yeah, look, at the moment there's a lot of, they bought that Californian winery for, I think it was 1.6 billion. This is a sizable transaction. I like the transaction, but there is some risk there. I think Treasury Wines is very cheap here at the moment. It's trading at a price to book value under 2. And look, overall, with such an enormous acquisition, they're going to be, the books are going to be a little bit muddied for a while. There'll be a little bit of uncertainty, but Treasury Wines is a better company than what it was when tariff wars started last time. They've actually got wineries in China now, and if they mix 5% of Chinese wine with Australian wine, it's not subject to tariffs, and etc. So as far as a trade war goes, Treasury Wines, because they've been through the pain of having to restructure that business, are probably the most experienced players in how to avoid it, basically. And now they've got operations, obviously, in Europe, in China, and in the US. The Dow Wines brand is something like 12% of the US premium wine market. So I think that long-term strategic acquisition, I can see Treasury Wines over a 2 or 3 year period going back through those mid-20 highs. But at the moment, people have been burnt pretty hard, and they're talking trade wars, first thing that comes to mind. But I think they're in a much better place than, they're not going to be blindsided by any potential tariff wars, because they know the workarounds now and they know the loopholes.
All right, you're making me thirsty, and their fast is over. Mark Gardner, always good to chat. Thank you so much, Mark Gardner from MPC Markets. All right, well, the stock of the day today, speaking of Cyclone Alfred, was QBE Insurance, and Henry Jennings from Markets Today and Andrew Wallant from DP Wealth Advisory joined me on the call.
QBE, the results were good. The stock has pulled back, as has the rest of the market, I guess. And part of that function is not just on this cyclone, but also on the fact that interest rates effectively have pulled back as well, with bond yields falling. So that is something to take into account as well. It did spike on the results. It's sort of coming back to earth. I think it's certainly an accumulate. But when you look at IAG and Suncorp as well in the same sector, and probably more exposed because they don't have that geographical diversity that QBE does.
Or the return rather over the last 3 years has been around 30% per annum. So certainly that's great. But to Henry's point, falling bond yields unfriendly for insurance companies, and obviously all this stuff going on, albeit Henry also mentioned the government mitigation piece. Look, I'm not a huge fan of insurers because I'm not confident they've actually priced the risk appropriately for climate change. And what I mean by that is they're pricing it correctly. It's just whether the customers are willing to pay for it is probably a better way of describing it. But it's a quality business. I note that the chair's been adding to his holdings over the last 12 months. QBE has also got the highest return on equity out of the main insurers. So certainly on any pullback, it'd be definitely one that you'd have on your list. But at these levels, it's a hold.
All right, let's get to the market leaders on a down day today. Kicking it off with West African Resources, which was up by about 6%. Insignia Financial also looking good, along with Bellevue Gold, Helios and Liontown Resources. The laggards, though, today, we're just talking about Treasury Wine Estates. It did go ex-div, but also fell more than that, 5.6% loss. Netwealth, Coles, a lot of ex-div stocks today weighing on the market, blocked down by 4%. In the small end of town, Appen. Now that was a stock that Gemma Dale from NAB Trade told Nadine earlier today was one that a lot of clients there are sort of picking or nibbling, I think was the word Gemma used. Novonix also looking good. Polymetals, Aura Energy and Melbana Energy to the downside today. NZK Salmon, they were off by 11%. Vinyl down by 9%, and some lithium players under pressure as well. Let's have a look at what we are looking out for tonight. PPI, so factory price inflation essentially from Europe, the US final services PMI along with the Fed beige book, and the ADP employment change for February. Tomorrow we have got monthly building approvals, also goods trade balance data coming through, and some big name ex-div players. So we talked about Woodside, also BHP, Rio Tinto, Medibank, and the jeweller levies also trading without rights to its dividend. A final check on where the market is this Wednesday. As Mark said, given everything that's happened, and we heard from President Trump on the floor of Congress, it's not too bad of a loss, 0.7%. Also where we saw the ASX 200 fall, 57 points, 8,141. Worth noting, last time I checked, you are seeing a little bit of tick up coming through in European equity futures. The index, though, down by 1.2% over the last 5 days. And sectorally, we mentioned consumer staples, energy, consumer discretionary really were the laggards today. All right, we do it all again tomorrow from 9:45 a.m. Eastern. We'll see you then.